Hello friends, I am Dr. Pragnesa. I have uploaded around 50 videos on the laparoscopic surgery. I have recently uploaded a video on laparoscopic ureteric reimplantation for my medico friends. So this is first time I am uploading the video on stock market that is for long-term investor. Let's see how it works out. My mother always says go for Saraswati ji, Lakshmi ji will follow her. So let's acquire knowledge that is Saraswati ji about stock market to create wealth that is Lakshmi ji. Lakshmi ji stays with the person who also worships Saraswati ji. You know who is this guy? This is KBC5 winner Sushil Kumar. He won 5 crore in 2011. However, he failed to invest this money wisely and soon enough he went bankrupt. Wealth may come to someone who does not have knowledge, but it does not stay there. As they say, a fool and his money are soon parted. How a person with 50,000 salary can beat a person with 1 lakh salary? That is also 7 times. Should I invest for rent income or should I invest in stock market? Most Indians love physical assets and like property and gold and consider them as safe. But which asset will give superior return? Should I invest in mutual fund or should I invest in stock market? Mutual fund is a good asset class to invest for passive investors who don't want to do in-depth study. If you cannot digest volatility, neither you go for stock market nor mutual fund. What is magic factor for wealth creation in stock market? That is compound interest. Why one should never go for penny stocks and for turnaround stocks? Stocks that are cheap for reasons. So don't go for that cheap stocks. Why one should avoid trading? Only full-time professional traders should go for trading. How a layman miscalculate investment return? People say I got 200% return. But what is the duration of investment? So go for CAGR return, not absolute return. CAGR return calculates the duration of investment while absolute return does not consider the duration of investment. I expect minimum 30% CAGR return from market. Great, at this rate you will own a big island. That is very funny thing. What a big deal whether I make 18% CAGR or 15% CAGR return. Just 3% higher return will double your asset. We will have detailed explanations to above questions in this lecture, particularly in the last half of lecture, so watch video till end. So I will start this lecture with one of the most important and example, and that forms the basis of whole lecture. So many people know how to earn, but very few people know how to invest. So let's take one example. There are two friends, friend X and friend Y. Friend X invests around 1 lakh rupees per month in fixed deposit. He earns also 1 lakh rupees and he invests that money in fixed deposit. He gets 6% CAGR return and he invests that money for 20 years. There is other friend, he is friend Y. He earns around 50,000 rupees per month. He invest this 50,000 rupees in stock market. He is very good at stock market and so he gets 16% CAGR return. He invests that money for 20 years. So now let's see what happens after 20 years. So after 20 years, friend X invests total amount 244 crore rupees, that is converted into 4.64 crore rupees, while the friend Y invests total 1.2 crore rupees and that grows to 8.74 crore rupees after 20 years. So there is huge difference. Friend X earns totally 2.40 crore rupees from his profession or business, while he earns other 2.20 crore rupees from investment, while friend Y earns 1.2 crore rupees from his profession or business, while he earns 7 crore rupees from his investment. So there is huge difference. Why there is so huge difference? It is due to the magic factor called compound interest that we will see later in this lecture. So there are some myths of stock market. The stock market is gambling. People become rich overnight in stock market. Huge accounting knowledge is required for stock market, and trading is all about making fast money. However, the facts are stock market is not gambling. It requires disciplined investment approach. Stock market gives huge return over a period of time, not overnight. It requires just 20% knowledge. However, it requires 80% behavior for good return in stock market. Trading is long process that requires frequent buy and sell. So there are few fun facts that will excite you for stock market investment. However, be careful before investing in stock market because investing is not so easy in stock market. So if you have invested 10,000 rupees in Infosys in 1993, it would be around 11.5 crore rupees in 2020. If you have invested 10,000 rupees in Wipro 40 years back, it would be around 700 crore rupees today. There are many stocks in which if you have invested crore of rupees 20 years back, it will be almost zero today. So there is always risk in stock market. We have to make strategy that reduces risk and gives optimum return. Now I will advise my all friends to away from trading. There are two important reasons to away from trading. The first one is trading and short-term investment will require frequent buy and sell. So you have to see daily share price movement. So that will distract your mind from your primary business or the primary profession. And second thing, trading or short-term investment may give good return in short term when the market is bull. However, over long term, over a period of time, the long-term investment always gives superior return than trading. While investing, always remember that Rome was not built in a day. While trading, always remember that Hiroshima and Nagasaki were destroyed in a day. So now how to calculate the return? So there are two type of the returns, absolute return and the CAGR return. So most of the investors what they do, they calculate the return on the absolute basis. However, when the investment duration is more than 1 year, you cannot calculate on the absolute basis. You have to calculate on the CAGR, that is compound annual growth rate. So let's take one example. Investor invests 1 lakh rupees in the stock market. Over a period of time that grows to 3 lakh rupees. So the absolute return here is 200%. However, here the duration of investment is not known. So that return may be good or may not be good depending on the duration of investment. So let's say if the duration is 4 years, the CAGR return will be 31.61%. So that is very good return. However, if the duration is 10 years, the CAGR return will be just 11.61%. So that is very good return. So whenever you calculate the return, calculate on the CAGR basis. So how to calculate the CAGR return? So first put initial value of the asset, final value of the asset and duration of investment. All these three things you put into the CAGR application that is available in the Play Store, and you can have your CAGR. CAGR return averages the return over a period of time. So let's say fixed deposit. In fixed deposit, the CAGR, the return is fixed return, that is 5 to 6% return. However, in stock market or the mutual fund, the return is not fixed. The return varies in different years. Like in for 1 year, it may give 30% return, while in other it may give just 10% return. So what does CAGR return does? CAGR return averages all these returns over a period of time. So you can compare one CAGR return with the other asset. Like you can compare the return of asset with the return of stock market or with the mutual fund return. So you can have better idea about how the asset grows over a period of time. Third particular thing about the CAGR return is it takes the compound interest into the account, that is Chakravarti Vyaj. So we will see later in the about the compound interest. So now I will discuss about different asset classes. The first one is fixed deposit. Fixed deposit normally gives 5 to 6% CAGR return. However, there is no risk at all and no studies required. Second one is gold. Normally, gold gives 9 to 12% historical CAGR return. In 1972, the gold rate was around 200 rupees. In 2022, it was around 52,000 rupees. So, when we see this figure, we feel that it is very high return. But when we then put them in CAGR application, it is 11.77% CAGR return. So, that is medical return. There is no risk at all in gold and no studies required. Third one is mutual fund. In mutual fund, normally the return varies from 10 to 14% CAGR return. The risk here is minimum when the duration of investment is more than 10 to 15 years. However, in short term, it does not give return. Here also no studies required. It is totally passive. The fourth one is rent income. Normally, rent overall gives 8 to 12% CAGR return. Now, normally the rent income is around 4 to 5% of the invested capital, and 5 to 10% is normally property appreciation. So overall you get 8 to 12% return on investment from the rent income. The others one are plot investment, land and stock market investment. Out of all these investment, land and the stock market gives highest return. In land, return may vary from 12 to 20% CAGR return overall on the depending on the location of land. However, there is risk of debt investment is there, and deep knowledge and huge amount is required for purchase of proper land. Stock market return varies from complete erosion of the capital to very high return, that is 20%. So risk is high and reward is also high. in-depth study, patience, and discipline are required for good return in stock market. Now, there is one important question, that is how much return one should expect from the market. So we hear sometimes very funny things from the people. They want 25-30% CAGR return, then they will be satisfied with such return. So Peter Lynch says at that rate they would own half the country along with Japanese and the Bass brothers. So in certain years you will definitely make 30, 50, 60% return, but in other years you may make just 2% or you may lose 20%. So Warren Buffett has around 20.1 CAGR return over 1965 to 2021. So one should expect 14 to 80% CAGR return over long run. So what happens if one expect huge return? So if you expect very huge return, you may become greedy and you may take very irrational decisions. So never expect unrealistic profit in short time. Market will give you good return, but that is in long run and that is over a period of time and due to the magic factor called compound interest. So one should expect minimum 14 to 50% CAGR return after 3 to 5 years of investment. Why so? Because if you are not getting even 14 to 50% CAGR return, then it is better to invest in mutual fund and don't invest in stocks directly. So now this is very important slide, how stock market make you wealthy. So what is compound interest? Compound interest is interest on interest. That means if you have invested principal amount and that you earn interest on that amount and same interest is also reinvested. So huge wealth is created due to compound interest. Compound interest is the eighth wonder of the world. This timely statement is one of the driving forces behind wealth building. So now let's see how compound interest work. Suppose you have invested X amount, your asset is growing at 15 to 18% CAGR. So then your asset will double by every 3 to 5 years. So suppose you have invested X amount, then at the end of 8 years it will be 4x, at the end of 16 years it will be 16x, at the end of 24 years it will be 64x. So two very important clues we derive from this formula are, whatever return you earn in whole investment life cycle, you will earn same return in last 4 to 5 years, considering the CAGR of 15 to 18%. So in this case, it took around 20 years to earn 32x, while it took just 4 years to earn another 32x. Very, very important. I had seen many of my medico friends invest in unknown businesses and they make loss or make no return. So making no return is also a loss of opportunity. So this is huge opportunity cost as overall return decreases. Now we will see how the decrease in CAGR return affects overall return. So if CAGR return is 18%, then in 24 years the X will be 64x. We had seen that thing. However, if CAGR return is just 3% less, that is 15%, then in 24 years you will make 32x, not 64x. So just 3% less CAGR over 24 years will give half return from 64x to 32x. So try to optimize your CAGR return and let compound interest work for you. In short, in whatever asset you invest, if it doubles in 3 to 5 years, you are on the right way. So now how to beat index? That means how to make more profit than index fund. Your aim should be to beat the index fund in long run, say 10 to 15 years. If you are not getting more than 12% CAGR return over a period of time, then why to invest in stock market directly? You can invest in mutual fund and get same return. So investor has three options to invest in stocks. The first one is invest in very well known large cap companies. However, there are two things about the large cap companies. First one is, as large cap companies are well known in market, you hardly get them at discount price. And second thing, most of the large cap companies have less growth rate than small cap. So these are the two reasons that few large cap companies beat the index. Second approach is be contrarian. Contrarian means you go against the market. Let's take one example. If some product of the company is becoming obsolete and even the company is making losses even though you invest in that company, so that is contrarian approach. But for normal people it is very, very difficult approach and you may have high risk for this contrarian approach. So third option is invest in little known companies. So this is the place where you find multi-bagger stocks. Peter Lynch says true contrarian is not investor who takes opposite of the popular hot issue, but true contrarian buys the stocks that nobody cares about. So invest in companies that is little known and little discussed in financial community. So there is triad of these three things: the little known companies, second is small cap, third is the growth stocks. So triad of these three is the place where you find 10 baggers, 20 baggers, or even more, and that will give you huge return over a period of time. So in subsequent series of lectures we will see these things in detail, what to buy, when to buy, and other all things. So how much amount one can invest in market? So that is very common question. So for that, first we have to see the predictability of the stock market in near term as well as in long term. In short term, say 3 to 5 years, stocks are not predictable. However, in long term, we can predict the stock market that will give good return. So Peter Lynch says whether the stock will go up or down in next 2 to 3 years, you might well flip a coin to decide. Same way, the Philip Fisher says it is little bit easy to predict which stock will give return, but it is very difficult to predict when the stock will give return. So these legends cannot predict the stock market in next 3 to 5 years. So two clues from these slides: always invest that amount which is not required in next 3 to 5 years. Let's take an example. You have saved money for your children's higher education. Now you think that I put this money in stock market, and after 3 to 5 years I will withdraw that money from stock market for my children's higher education. However, like corona or other thing happens and market crashed, and so you have to sell these stocks and you have to make loss. So don't invest money that is required in near future. And second thing, invest only what you can afford to lose without that loss having effect on your daily life. During professional career, a doctor read minimum 15 to 25 books. However, when it comes to investment, doctors are most speculative and invest without reading a single book. So when I ask my doctor friends to advise me about good stock to invest, they advise me, a lot of friends advise me to invest in Yes Bank in 2019. So when Yes Bank fell from 400 rupees to 15 rupees, many of my good friends were averaging and they were buying more and more stocks. When I asked them, why are you investing in such falling knife? The most common answer was, the stock has become so much cheap, now it hardly goes down. So those who have read books on the Warren Buffett, they will always remind themselves that turnaround hardly turns around. Means when the company is making loss, it is very difficult for them to become turn around. So Yes Bank may turn around in future, but it is not our doctor's cup of tea. I request my friends to read following books and develop his or her investment philosophy before investing in stocks. However, I sincerely recommend two books, that is One Upon Wall Street by Peter Lynch and 100 Beggars by Christopher Mayer. Each and every point described in this my presentation is very important, as I have precisely shortlisted these points from these top rating investment books. So my motive behind this series of lectures is every investor should develop disciplinary approach of the stock market that reduces risk and gives optimum return. Don't do haphazard investment. Now there are two phases of the stock market: bull phase and the bear phase. During the bull phase, the most of the stocks go high, while during the bear phase, either stocks go sideways or stocks go down. So during bull phase, then the stocks are going up. Most of the investors feel that they have good investment strategy. However, it is the bear market when the bear phase comes. The persons with actual good strategy with disciplined approach withstands the unfavorability of the stock market. For others, the bubble bursts and all assumption of the short success and the profits falls apart. So Warren Buffett rightly said, it is only when the tide goes out you know who is swimming naked. So now knowledge and behavior, this is very two important things required for return in the stock market. Most of the people says market is gambling. Few people says market requires huge accounting knowledge. However, the reality is different. Winning at money in stock market requires 80% behavior and 20% knowledge. So it is what you do, not what you know. Financial outcome is soft skill where your behavior is more important than your knowledge. So all these slides says the behavior is more important than knowledge. Let's see. First I will mention about knowledge. So investing is not rocket science, and investing in the stock market is relatively easy to manage if you do the right way. The more you know about the company, it is better, but it is not imperative that you call the company, nor you have to study the annual report with deep concentration. Peter Lynch says that 20 years in this business convinced me that normal person using just 3% of the brain can pick as good stock as Wall Street expert. So you don't need to be chartered accountant to make money in market. So if you could tell the future of a company by just looking at balance sheet, then all the mathematicians or the accountants would be the richest people in the world. So all these slide says you just require 20% knowledge. Now the behavior, that is very important. All legends says behavior is more important than knowledge. So first is the patience. The Warren Buffett always says the stock price will follow the company's earning in long term. So in long term, always stock and the earnings that becomes parallel to each other. So if you have chosen the right stock, you have to be patient with it, because in the short term, due to greed and the fear, stock may go up or down. However, in long run, stock will go as per the earning price. So once the CEO of Amazon asked the Warren Buffett that your technique of the investment is so easy, why everyone just don't copy it? Then Warren Buffett says, because no one wants to get rich slow. People have greed to become rich overnight, and there are always greedy people in the market who take advantages of these greedy people. So hence Buffett says the stock market is a device to transfer money from the impatient to patient. So patient is more important than the knowledge. I will give you one example. My friend Palaksa, I am saying his name because he has introduced me to the stock market. Now in 2008 he bought one stock, and that is Kingfa Science and Technology. He bought that stock at around 60 rupees. In 2017, where I entered in the market, it was around 800 rupees. In 2021, he sold it at around 1200 rupees. So it was just 20 buckets for him. I have seen many of my medico friends, they are just keeping stock for 1 or 2 years, and or sometimes they sell when it becomes double. So this is the importance of patience. You cannot have these type of multiplicators if you don't invest them for 5, 10, 15, 20 years. So the other things that is important for behavior is greed and fear. Greed plays very important part in our financial well-being. If we are greedy, we provide ready material for someone to exploit our greed. Greed and jealousy seems to be the biggest sins for the investors to be getting trapped. So I will give example for the greedies. The well-known example, that is dot-com bubble. In 1995 to 2000, internet industry was very hot industry. All people want internet stocks in their portfolio. So their valuation becomes so high that price earning ratio was around 200, 300, 400. Normal price earning ratio is mostly around 20, 30 or 40. Some loss making internet companies were also going high and high, because people were buying them. People were buying them because they were thinking that these stocks will never go down. So that is greed. Due to the greed, people forgotten about the valuation criteria, and they want these internet stocks at any cost. So then in 2000, the internet stock bubble burst, and all the internet stocks were gone down. So this is the importance of greed. And other thing is fear. If you cannot withstand the fear of 50% people loss on your stock, stay away from the market. That is by Warren Buffett. We had seen such fear during Corona time, during this internet bubble burst, and also during the 2008. So fear is also very important. We have to control that fear. Other behavior metrics like self-reliance, common sense, tolerance of pain, open-mindedness, flexibility, admit mistake, and ignore general panic. These all things are required for making good return. However, three important, that is patience, greed, and fear. Now I will briefly describe my journey. I started investing in stock market in 2017. In beginning, I paid tuition fees by making few losses. However, soon I understood that deposit investment will not give return. So I started reading books, and I also started reading various online material in between my laparoscopic surgeries, and I applied these principles in investment and started new journey. In 2020, market crashed due to corona, and my portfolio was around 40% down. On one side, I was regretting as biggest mistake to invest in stock market, but on other side, the Warren Buffett quote came in mind: market crash like opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. So I did not just hold, but buy more stocks during that time. Last but not least, long-term investment strategy is simple to understand but difficult to follow due to our behavior bias, particularly greed and fear. So as usual, simple is not always easy. So this video is only for educational purpose. All viewers are requested to take experts' opinion before taking action. Please subscribe my channel for next video of lectures. Thank you very much.